You know the name Goldman Sachs, right? I mean, it's this titan of Wall Street. You think huge wealth, but also, let's be real, a lot of scrutiny sometimes.
Definitely. And you wonder, how did they actually get there? It wasn't overnight.
Exactly. What were the key moments, the people, the Goldman ways that built this absolute powerhouse?
It's a journey that's way more complex and honestly more surprising than the sort of monolithic image people might have. Understanding Goldman is like getting a master class in how modern finance even evolved.
Totally agree. So today we're doing a deep dive into that fascinating, complicated, and yeah, sometimes pretty controversial history of Goldman Sachs.
We've got, articles, research, notes piled up here.
Yep, trying to pull out those crucial moments, the things that really define them. The mission is basically to track how they went from, well, really humble beginnings to being this central player in global finance and find those little nuggets that show their true character.
And we think you'll have some real aha moments. This isn't just like a dusty history lesson about one company.
No.
It's more a window into the whole world of finance, power, ambition, and that constant push-pull between making money, keeping your reputation, and what the public thinks.
Okay, let's start right at the beginning. Because the origins, surprisingly, low-key, we're talking 1869. Marcus Goldman.
Just him, a sole proprietorship, 30 Pine Street, New York City. And get this, the office was in the cellar.
Next to a coal chute. Can you even picture that today?
No, a massive contrast to the glass towers now, right?
Yeah.
But his business, Marcus Goldman's initial thing, was pretty simple, but like fundamental. He bought and sold IOUs.
IOUs, like commercial paper today.
Exactly, from local businessmen. So these small shops could turn their accounts receivable, money people owed them, into cash right away. They didn't have to wait or go through a big bank.
But even with the coal chute office, apparently the man himself, Marcus Goldman, looked the part. Sources say he wore a tall silk hat and Prince Albert frock coat.
Yeah, it looked like an aristocrat, even down there. He literally carried his business in his hat, apparently, just understanding how badly merchants needed that quick cash flow.
It's like the perfect early example of the time value of money, isn't it?
Absolutely. He buys these IOUs at a discount, knowing he can collect the full amount later.
Yeah.
That difference, that's his profit. It's basically an early form of, short-term lending, credit intermediation.
So the firm really becomes Goldman Sachs when his son-in-law, Samuel Sachs, joins up.
Right. And they were, apparently, quite the contrast. Sources describe Samuel Sachs as really conservative, even wore a thin alpaca office coat on hot days. Very steady.
While Marcus was the founder and Samuel the sort of a conservative anchor.
It was Henry Goldman, Marcus's son, who was the early risk taker, the
Yeah.
ideas guy. And that dynamic, the ambitious one versus the cautious one, that tension kind of defines the firm again and again through its history.
And the family was all in. There's this great story from the Panic of 1907 about Samuel Sachs's son, Walter. He's off doing the grand tour of Europe, supposed to be his big banking education, right? And his dad cables him in London. My boy, you come home and go to work. Boom.
Haha. Tour over.
Right.
At least this time. That sense of immediate responsibility, jumping right in, that was clearly there early on.
So from IOUs, they quickly move into underwriting, helping companies sell stocks and bonds to the public.
Yeah, they did deals for United Cigar Manufacturers, even the state of Alabama back in 1906. Pretty big step up.
But the real game changer, the one everyone points to, is the Sears Roebuck IPO, 1906 again.
Right. Julius Rosenwald at Sears needed money. And Henry Goldman apparently said, forget a loan, let's take you public. That was innovative.
It wasn't just finding money. It was like strategically shaping the company for the public market, a whole different level.
Totally. A big evolution from just trading paper. And their influence started stretching beyond just business, too. 1914, Henry Goldman is advising President Wilson's cabinet Megadu, Houston, on setting up the Federal Reserve.
No.
Yeah, he argued hard for New York to have the strongest Fed bank, talked about psychic factors, needing that concentration of capital to give markets confidence. And, well, they listened.
Okay, but here's where it gets complicated. World War I.
Yeah, this is a big one. Henry Goldman, despite the firm being very American by then, was apparently quite pro-German.
And Goldman Sachs had this rule. Any underwriting deal needed unanimous partner.
Okay. So, because of Henry's views, the firm actually refused to get involved in the big Allied bond deal, which was, huge business.
Sources say not good for business. Big understatement, probably.
For sure. But interestingly, while the firm stayed out, Walter Sachs, the son, pulled back from Europe. He personally bought some of the bonds. Shows you the internal disagreements, right?
Definitely. And this period also led to the split with Lehman Brothers. Goldman somehow managed to grab like 41 of their 60 shared clients, including Sears. Pretty cutthroat early on.
Absolutely. They were already showing that
Yeah.
competitive streak. So they navigate these early bumps, establish themselves, and then comes the roaring 20s, speculation fever.
And a new, kind of controversial figure steps up. Waddell Ketchings, Harvard guy, wanted to blend theory and practice.
Right. And Catchings really pushed these things called investment trusts. Think of it like, well, a company that sells its own stock to the public
Okay.
and then use that money to buy a bunch of other companies' stocks. Sort of like an early version of a leveraged hedge fund, maybe, but way less sophisticated strategies than today.
Amplifying returns, basically.
That was the idea. And the Goldman Sachs Trading Corporation IPO in 1928, huge hit.
Okay.
Public buys shares at $104. Goldman, the firm, owns shares it got for $10.
Wow. Instant massive profit for the firm. But uh-oh, here comes the controversy, right?
You guessed it. A 1932 congressional report looking into the crash basically accused Goldman Partners Catchings and another guy, Sidney Weinberg, of what it called one of the first recorded instances of insider trading.
Whoa! What did they supposedly do?
Manipulating the trading core's stock ahead of a merger.
Right.
Now, the rules were different then, maybe not strictly illegal, but definitely raised huge ethical flags about conflicts of interest.
And then the whole thing just imploded.
Spectacularly. The trading corporation stock went from like $326 down to $1.75. Goldman lost its $10 million investment plus another $3 million. Shareholders lost hundreds of millions.
Ouch.
Yeah. Walter Sachs, the guy from the '07 panic, he steps in and basically fires Catchings. Clipped his wings, as the source puts it.
So out of that total disaster emerges a new leader.
Exactly. Sidney Weinberg. Total underdog, ambitious overachiever, they call him. He's the one who resurrects the firm. And his background, so different from Wall Street.
Yeah.
8th grade education, got a job recommendation, say he was happy when he was busy, started as a janitor's assistant, worked his way all the way up.
Incredible story. And he had this wit, right? Made jokes about the very mess he cleaned up.
Legendary wit. My favorite is the golf caddy story. He asks a caddy his age. Caddy says 36. Weinberg shoots back, I guess you must have run an investment trust.
Uh-huh. That's brilliant. A little self-deprecating nod to the trading core failure.
Totally. But beyond the jokes, Weinberg's real strength was connections, especially political ones.
Ah, right. He was buddies with FDR.
Yeah, he had the prescience, as our sources say, to back Franklin Roosevelt early, even help with his 1932 campaign finance. This was huge because most of Wall Street, the street, was against Roosevelt.
So Weinberg was this sort of clubhouse Democrat, stood out, built bridges.
Exactly. And his influence went deep into corporate America, too. He sat on tons of boards, GE, General Foods, you name it. Sources talk about his 3 lives interweaving.
And those board seats meant...
Lucrative underwriting business for Goldman Sachs. It was all connected.
Makes sense. But that network also attracted attention, right? The antitrust lawsuit.
Yep, 1947. The government goes after 17 big Wall Street firms, Goldman included. But funnily enough, Goldman was apparently pleased to be sued.
Pleased. Why?
They saw it as proof they'd made it. Recognition that they were one of the most powerful firms showed their aggressive, competitive side. The judge in the case even noted that like 55% of Goldman's deals involved a partner sitting on the client's board.
So this was Weinberg's value of friendship idea in action. Loyalty wasn't just personal, it was business strategy.
Absolutely. It built this pipeline. People who left Goldman often remembered the firm, sent business back, defined that whole era. But, the financial world keeps changing.
Right. So after Weinberg's incredibly long run, like 50 years, who takes over?
Gus Levy in 1969. And he brings a totally different vibe. Levy was an arbitrager guy.
Arbitrage, so profiting from tiny price differences, high-speed, high-stakes trading.
Pretty much. Levy was apparently brilliant at guessing correctly, making huge profits fast. Like one source says he made nearly twice the profit on a single Texas Gulf trade than Weinberg made on the whole Ford IPO, and in way less time.
Wow, that's a different game entirely. But what about information? How did that work back then?
That's the fascinating part. Insider trading rules in the 60s, still really fuzzy, not black and white like today. The whole point of event-driven arbitrage was kind of finding stuff out that others didn't know.
So kind of a gray area, pushing the boundaries for an edge.
You could say that. There was definitely an aggressive culture around getting information, maybe almost by any means necessary.
And did that create tension, like between doing the right thing and doing business?
Oh, yeah. There's a story about an arbitrager, Bruce Mayers. He actually resigned because Levy told him to cancel a trade to please a big client. Mears felt it was wrong. Levy prioritized the relationship.
Hmm. So what does that moment tell us about Goldman's priorities?
Well, it showed, I think, that client loyalty was huge, but maybe not absolute if it threatened the firm itself, especially if the other party was seen as a sophisticated adult investor who should know the risks. It sort of set a precedent.
And that precedent got tested, right? Penn
Yeah.
Central.
Big time. 1970, Penn Central Railroad goes bankrupt. Goldman had been selling its commercial paper, but here's the thing. Evidence suggests Goldman sold its own holdings of that paper back to Penn Central.
While still selling it to other clients,
Yeah.
without telling them the situation had changed.
Exactly. Without disclosing the increased risk, they ended up paying only like $50,000 in settlements later.
And there was another case, Mill Factors.
Similar situation. Creditors, like a bank, felt Goldman was negligent for recommending the paper, wanted Goldman to cover their losses.
And Goldman said,
Nope, refused.
yeah.
Didn't want to set that precedent of bailing out investors, even if they felt misled. Again, protecting the firm seemed paramount.
It's kind of amazing how they manage the PR, though. Gus Levy does this big interview in Institutional Investor in '73.
Yeah.
And somehow none of the Penn Central mess, none of the lawsuits get mentioned at all, just poof, avoided.
Masterful spin, maybe.
Yeah.
But they face other challenges, too, like on race.
What happened there?
1970 again. A black MBA student from Stanford, Jerome Caulfield, gets turned down for a job. Allegedly, a partner said it was basically a bigot's decision higher up.
Oh, wow. How did Goldman respond?
Gus Levy wrote a letter denying discrimination, pointed to diversity numbers, but the numbers mostly included like clerical staff, janitors, only one black professional listed at the time. It really highlighted an early structural issue with their hiring.
Okay, so moving forward a bit. John Whitehead. He becomes a really key figure, right, in defining the Goldman way.
Huge figure. And his personal story is pretty intense. His family lost almost everything in the 1929 crash.
That must have shaped him.
Deeply. His mother apparently told him, make up for our terrible loss. So he had this incredible drive, almost like a Boy Scout zeal, sources say.
And he worked on the Ford ITO, too.
Yep, called it a big, big event for Goldman Sachs that put us on the map. But his biggest legacy, those 14 principles.
Oh, yes, the famous principles. What was the point of those?
It was really about institutionalizing the culture, making the Goldman way something consistent, scalable that didn't just depend on one person's network, like Weinberg's, trying to codify behavior.
And people noticed, didn't they get nicknames like cyborgs or Manchurian bankers?
Yeah. It created this really consistent, maybe even intense approach. But it worked, especially as they expanded globally. These young, bright Goldman bankers started making waves in London, taking on the old British merchant banks.
Okay, so the 80s and 90s. We get Steve Friedman and Robert Rubin leading the firm. Modernization, but also more scandals.
A bit of both. The J. Aron acquisition in '81, that was a commodities trading firm, it was almost a disaster at first.
Why? Culture clash.
Big time. The J. Aron guys, including a young Lloyd Blankfein, apparently made fun of the straight-laced Goldman bankers. They wore red suspenders just to, tweak them.
Huh. But Blankfein turned it around.
He did. He saw the opportunity, took charge, and really proved himself, showed his ambition.
And Goldman also tried to change its image a bit in this era, the pacifist thing.
Right. A 1982 Wall Street Journal piece highlighted how Goldman positioned itself as not representing corporate raiders in hostile takeovers. A definite shift from Gus Levy's time helped build that client-friendly image.
But image versus reality. Insider trading cropped up again.
Yeah, the Robert Freeman scandal. He's head of arbitrage, got caught up in the big insider trading crackdown of the 80s. Rudy Giuliani, the prosecutor then, called it the tip of the iceberg.
And there was that infamous line, "Your bunny has a good nose."
Yep, from a taped call. Plus allegations they traded on a secret gray list of stocks they shouldn't have touched.
How did Goldman handle that?
Well, Freeman's defense argued they followed internal rules, denied the gray list thing. It was damaging, for sure. But then almost immediately after, the 1987 market crash happens.
Yeah.
And Robert Rubin tells the arbitrage desk, basically stay calm and double up. They ended up having a record year for profits. Just shows their ability to navigate even profit from chaos.
But not all controversies were financial. The Louis Eisenberg harassment scandal.
Right, 1989, that got very public. Involved his assistant, a police officer got involved, Page 6 reported on it. It was messy. Eisenberg eventually left, reportedly with $30 million in stock, and later held big public roles. A tough look for the firm's image at the time. So, fast forward to the 90s. More turbulence. Rubin leaves for the Clinton administration in '93. Steve Friedman's flying solo.
And things get rough.
Really rough. 1994, they have huge losses, like over $100 million a month. Paulson later called it a massive wrong-way bet on interest rates. Basically, credit spreads just blew out.
Meaning the gap between interest rates on safe versus risky debt suddenly widened.
Exactly. And it caught them badly. It exposed this trading culture that had gotten a bit too suck it and see, maybe a bit undisciplined.
So big losses mean big changes.
Yep. Leadership shift. Henry Paulson and John Corsine take the reins. First thing they do, set up a formal risk committee, boost the status of auditing and risk management. Paulson basically said, new sheriff in town.
And around this time, they start seriously thinking about going public, right? An IPO.
Yeah, the pressure was building. Partly driven by a big investor, the Bishop Estate in Hawaii, wanting a massive payday. But the partners, they were deeply divided.
How divided?
Sources talk about a meeting with screaming and crying.
Yeah.
It was incredibly contentious, changing the whole partnership model.
And then LTCM happened, long-term capital management.
Right, 1998. This huge hedge fund, run by Nobel Prize winners, basically collapses. Goldman was a major counterparty, meaning LTCM owed them money, or vice versa.
And this created internal friction at Goldman.
Big time. You had Paulson, the investment banker type, wanting to cut their losses immediately. He famously said, "We're Goldman Sachs, not a hedge fund."
But Corzine.
Corzine, the trader, wanted to ride out the positions, hoping they'd recover. Classic trader versus banker mentality clash.
So what happened with the IPO then?
All that market chaos from LTCM. They had to pull the IPO plans temporarily, delayed it. And some partners were even forced retired in the aftermath. A really shaky period.
Moving into the early 2000s. Succession issues again.
Yep. Paulson appoints John Thain and John Thornton as co-COOs, potential successors. But Paulson kind of liked being CEO.
Uh-oh.
Yeah, he eventually maneuvered them both out. Cleared the path for other potential leaders like Lloyd Blankfein coming up through the ranks.
And as Goldman got bigger and more global, these conflicts of interest just kept growing.
Massively. They were involved in so many deals, advising so many companies, trading so many assets. Conflicts were almost inevitable. It became a beehive of global activity.
So how did they try to manage that?
They launched internal initiatives, things like compliance and reputational judgment training, created the Pine Street Leadership Institute, named after their original address, trying to instill values.
Did it work? What's an example of a conflict?
Well, the 2005 NYSE Archipelago merger is a classic. Goldman advised both sides of the deal.
Both sides.
Yep. And they were also the second biggest shareholder in Archipelago, plus the CEO of the NYSE at the time, John Thain, former Goldman guy.
This sounds complicated.
Paulson defended it, said it was legal, but he admitted it was a public relations problem. It showed they were willing to operate right up to the edge, even if it looked bad.
Okay, which brings us right to the doorstep of the big one, the 2008 financial crisis. Paulson leaves for Treasury.
Right, 2006. Very secret move to become Treasury Secretary under George W. Bush. Apparently surprised and delighted Lloyd Blankfein.
Who then becomes CEO.
Exactly, Blankfein. Brooklyn roots, known for being funny and entertaining, came up through that J. Aaron acquisition after a self-described pre-life crisis as a tax lawyer. A very different style at the top.
And the market backdrop is this originate to distribute mortgage machine, right?
Precisely. Banks making mortgages, then immediately selling them off to investors as complex securities. The focus shifted from, is this a good loan, to just generating fees from the transactions. Risk got passed down the line.
But Goldman saw trouble coming.
They did. A trader named Michael Birnbaum was key in building the Big Short for them. They started using the ABX index, basically a way to bet against the overall subprime mortgage market.
So they weren't just selling mortgages, they were actively betting they would fail.
By early 2007, they were significantly short the housing market, betting it would collapse.
And the ABC-US deals were part of this.
Those are infamous. Goldman created these complex mortgage-backed securities, CDOs, but in some cases, like ABCU 2007 AC1, they let a hedge fund, Paulson & Co., no relation to Hank, help choose the mortgages, knowing Paulson planned to bet against them.
While selling the other side, the long side, to investors like IKB Bank and ACA Capital.
Exactly. And this period gave us that notorious email from Goldman exec Tom Montag about another deal, Timberwolf. Boy, that Timberwolf was one shitty deal. He later said it was a joke.
Does it sound like a joke?
It raised serious questions about whether they were selling products they knew were likely to fail, and their overall strategy was pretty ruthless.
How so?
They started selling off their own holdings of mortgage assets, sometimes cheaply, just to cut their risk exposure, even took losses in Q2 2007 to get positioned correctly.
Well, other firms were still pretending everything was fine.
Right. Sources say other firms were in dreamland about the value of their mortgage assets. Goldman was aggressively marking to market, pricing assets at their true falling current value. Disciplined, but brutal.
Okay, so the crash happens, Goldman survives, even profits in some ways, but then comes the backlash.
Huge backlash. The AIG bailout in 2009 really fueled it.
Yeah.
Goldman got about $14 billion in payments through AIG, which it had deals with.
And the public perception was?
That Goldman got a special deal because of its connections, Paulson at Treasury, other former Goldman people in key government spots. Whether fair or not, that narrative stuck.
That's when the vampire squid label came out.
Yep. Accusations flew. Michael Moore even led a protest outside their headquarters. Goldman's image got seriously tarnished.
How did Blankfein handle it?
Initially, he denied they had a massive short position in 2007. Later, he kind of clarified, saying, well, we lost money, then made more than we lost because of shorts. He complained that the mortgage business, just 2% of the revenue, became this massive lightning rod.
But the scrutiny didn't stop. SEC lawsuits.
Yeah, like the Hudson mezzanine funding case. The SEC alleged Goldman made $1 billion shorting a CDO that it had sold to clients without fully disclosing its own position. Plus, Justice Department probes, constant rumors about front-running client orders.
Front-running meaning trading for their own account based on knowing what clients were about to do.
Exactly. Highly controversial if true. And competitors started saying the Goldman way had shifted.
Shifted how?
Some felt that while Goldman talked about clients first, the reality, especially on the trading side, was more like, what's right for Goldman is what matters. That they'd trade aggressively against client interests if it benefited the firm. Eat your lunch and screw you over, as one competitor put it.
Wow. So quite a journey we've traced from that cellar office next to a coal chute.
All the way to being this global financial behemoth, a story packed with innovation, incredible ambition, fierce competition.
And yeah, these recurring ethical questions, these moments where they clashed with public trust or even their own clients' interests.
It's really more than just one firm's story, isn't it?
Don't
It's
see
like
that.
holding up a mirror to Wall Street itself as it evolved. It shows you the complexity of the markets, that constant tension between profit, image, and maybe doing the right thing.
So the final thought for you listening. Goldman Sachs has shown this incredible ability to adapt, to reinvent itself, often under really intense fire. As finance keeps changing so fast, what parts of that Goldman way do you think will last?
Yeah, is it the relentless drive, the talent magnet aspect? Or is it the more controversial stuff, the pushing boundaries, maybe even the self-interest, and what new challenges are coming for a firm like that the world we're heading into? Makes you think, right?